You know that feeling, right? That pit in your stomach when you're watching the market swing wildly up and down. It can make you question everything, and honestly, it can lead to some really costly mistakes. But what if there's a totally different way to look at all that chaos? Today, we're diving into some incredible research that asks a pretty radical question. Can we actually tame market volatility? So that's really the big question we're tackling today. Is all this market chaos something we should be afraid of? Or is there a hidden opportunity buried inside those wild swings? Let's find out if we can turn all that market stress into a real strategic advantage.
Okay, so before we can even talk about solutions, we've got to get a real handle on the problem itself. What exactly is market volatility, and why does it feel so incredibly difficult for us, as humans, to manage?
I absolutely love this analogy. Just think of volatility as the market's pulse. When things are calm, you get a nice steady beat. But when big news hits, economic reports, global events, that pulse quickens. It gets erratic. It's not a bug, it's a feature. It's just how markets breathe.
Here's the thing, though. The real problem isn't the market's pulse. It's our own. Our brains are hardwired with these biases that make navigating the swings so tough. We see a crowd selling, and our first instinct is to panic and sell too. That's hurting. And then there's loss aversion, where a 10% drop hurts way more than a 10% gain feels good. It makes us do irrational things. Our own mind can be our worst enemy in the market.
So, if the market is going to be wild and our instincts can't always be trusted, what do? Well, what if we could flip the script entirely? What if instead of running from volatility, we could actually harness its energy? This is where things get really interesting.
You've probably heard of this one before. Portfolio rebalancing is a classic for a reason. The idea is super simple. Say you want your portfolio to be 50% stocks and 50% bonds. If stocks have a great run, you might end up at 60-40, so you sell some stocks and buy some bonds to get back to that 50-50 target. It's all about keeping your risk level where you want it.
Now, imagine taking that classic idea and putting it on steroids. That's where volatility harvesting comes in. The idea is to take that same rebalancing principle, but do it way more often, like every single day. By doing that, you're constantly selling a little bit of what went up and buying a little of what went down. You're basically, harvesting the tiny bits of profit from the market's natural rhythm. And this chart, wow, it just shows you the raw power of this concept. Look at those lines bunched up at the bottom. That's what happens when you rebalance monthly or weekly or not at all. Now, look all the way up at that top line. That's the portfolio that was rebalanced daily. Just by doing it more often, it was able to capture value from all those little swings and leave the others in the dust.
Okay, let's be real for a second. This all sounds great, but who on earth has the time or the discipline to rebalance their portfolio every single day? It's just not practical for a person to do that. But you know what it's absolutely perfect for? An algorithm.
And this is where technology just changes the game completely. Algorithmic trading systems can execute these strategies flawlessly, over and over again. They don't get greedy, they don't get scared, they just follow the rules day in and day out. They take that messy, emotional human factor right out of the equation.
And the word algorithm sounds complicated, but it doesn't have to be. Just look at this flowchart. It's basically a simple if-then decision. The system looks at two price averages, a fast one and a slow one, and it just asks, is the fast one above the slow one? If the answer is yes, it might take a more bullish position. If no, a more bearish one. That's it. Simple rules executed perfectly every single time.
All right, let's get to the juicy part, the evidence. The researchers behind this didn't just stop with simple daily rebalancing. They started adding more layers of these simple algorithmic rules to see if they could improve performance, especially during those really stressful market phases.
So check this out. The first thing they did was add that simple moving average rule we just talked about. And look what happens. See that top line, the augmented one? You can see a really clear jump in performance just from adding that one basic trend-following rule. Now, this is where they kicked it up a notch. They swapped out the simple rule for a slightly smarter, more responsive set of indicators. All you need to know is that these new tools help the algorithm react just a little bit faster to what's happening in the market right now. And you can see the result for yourself. That top line moves even higher. A slightly smarter rule delivered even better returns.
And then came the final, and maybe most powerful addition, a volatility kill switch. It's basically a safety brake. If the market's pulse gets too erratic, if things are just getting way too chaotic, the algorithm is programmed to just hit pause. It stops rebalancing and waits for the storm to pass. And as you can clearly see in the chart, that one safety rule, designed specifically for high-stress moments, led to the best performance of all.
Let's put some hard numbers on this, because they really tell the story. A basic buy and hold strategy on the S&P 500 got you about 8.8% per year. Pretty standard. The daily rebalancing with the smarter rules pushed that all the way up to almost 25%. But with that volatility kill switch, an incredible 29.89%. That's not just a little better. That is a whole different universe of performance.
So after seeing all of this, what's the big takeaway? Does this mean we've discovered the perfect can't-lose investing strategy? Well, not so fast.
We have to look at this with a really balanced perspective. The opportunity is huge, no doubt. The potential to outperform the market by using its own energy is exciting. But the researchers are very clear about the risks. This kind of performance comes with more bumps along the road, more volatility. And in a long, grinding bear market, a strategy like this could face serious losses. Not to mention, you have to be really smart about managing transaction costs, or they can eat up your gains. And that all brings us to a final, really powerful idea to think about. This research points to a potential shift in what it even means to be a good investor. As technology like this evolves, maybe the future isn't about trying to pick the next hot stock. Maybe it's less about which assets you pick and much more about the rules you choose to follow. A pretty fascinating thought to end on. Thanks for joining me.